Hello there. Welcome to IA Global Asset Management's quarterly podcast, where our portfolio managers and asset class experts discuss current market events, trends, portfolio allocation, and outlook. I am your host, Rose Marcello, and I'm a Senior Director, Client Portfolio Manager at IGAM. I have with me today Sébastien Mc Mahon, who is our Chief Strategist, Senior Economist, and Vice President of Asset Allocation. Sébastien oversees our managed multi-asset suite of portfolios. Today, we're discussing recession probabilities, the latest rate hike from the Bank of Canada, as well as the state of the labor market. Good morning, Sébastien.
Hey, good morning, Rose.
Happy to have you.
Happy to be here.
Nice. So, my first question today is about that elusive recession. I feel like we've been having this conversation since like summer 2022. Now we're about to start summer 2023. What
Mhm.
has changed and how has your probability been revised?
Yeah, we need to recognize that the first half of 2023 was much stronger than anyone had expected. Of course, we're in uncharted territory during the pandemic. Again, there was so much liquidity injected in the economy that the consumer is stronger than what was expected last year. Now, the odds are still high, especially in the US, that we have a recession. And again, a kind of a shallow recession, not something too dramatic, but in the US, when I look at the consensus of economists surveyed, what's penciled in for Q3 and Q4 of this year is two consecutive negative quarters. So that would qualify as a recession. You also need to look at industrial production, which is contracting year over year. You need to look at unemployment, which remains low. So this is maybe a mitigating factor here, and household income. So you have to look at all of these things, but still we think that there's some weakness ahead. Our macro framework is still pointing towards that. Maybe the good news is that in Canada, the odds seem to be much lower, mostly because of demographics. The amount of the quantity of new Canadians that's added month in, month out. This is a strong economic tailwind. Housing is also behaving better than we expected. And when you look at consumer confidence in the US, consumers seem to be very worried about the future, whereas in Canada, not so much. So I think this points to more favorable odds here, but we still stick by our call that there should be some kind of a recession in the US over the coming year.
So you mentioned some kind of recession. Interesting because one of the most debated issue would be a hard landing versus a slow deceleration. What would be the key differences and where do you position whatever you expect to happen? How do you position that right now?
Yeah, I mean, a hard landing would be if central banks were too aggressive over the last year or 15 months, and the economic data just, breaks, falls down very suddenly. This is not what we have in the cards. We think that the accumulated evidence of this tightening will lead to an economic slowdown, but it should be more of a shallow one. If you're an investor, well, if there's a hard recession, a very hard landing, then of course you want to be in bonds, you want to be in fixed income, you want to have duration, you want to have high quality corporate names. But if it's mostly, a shallow recession, it's still gonna impact the markets, mostly because there's a very clear link between the ISM manufacturing index in the US, so the economic cycle, and the ability of businesses on Wall Street to grow their sales and to grow their earnings. So our framework is pointing towards lower sales growth, lower earnings growth. So that's why we're more careful with the US given the valuations, and we tend to favor global ex-US equities with a particular emphasis on Canada, which is very cheap right now.
Interesting. So you spoke about monetary policy, and this is also something we've discussed internally in the past few days. It's like the seemingly bad timing of the latest rate hike by the Bank of Canada. What's your take on that?
Well, when you're studying economics in a university, there's always, when they talk about monetary policy and business cycle, they always tell you that most recessions, if not all recessions, are caused by monetary policy or central banks doing too much. So the question that comes right after is always, well, why do they always do too much? Why don't they stop earlier? Well, I think we have a good demonstration of that now. There's some impatience there from the committees that are leading the central banks. When we look at forward-looking indicators, we see that monetary policy seems to be working. Businesses are worried about their future sales. They're not looking to hoard labor anymore. So we're seeing all of this. But if you look at the actual data, you're not seeing an economic slowdown yet. You see inflation that's sticky. And I would say that it's normal because it's been well documented in literature that it takes between 18 and 24 months for monetary policy to do its to work its magic. And it was in the summer of 2022 that we saw the bulk of the tightening from both the Fed and the Bank of Canada. So about 12 months or even less than 12 months since. So I think there's some impatience there. We think it's working already. We think you just need to be patient, but there is a real risk that inflation becomes too much anchored if I am wrong and they are right, that they need to do more. So it's not an easy job being a central banker these days.
I wouldn't like that job myself. And we're speaking of the Bank of Canada, but the Fed to kind of telegraphed something a bit upsetting, I'd say, like they paused, but clearly indicated that there were two more hikes coming. Shouldn't they have hiked if they expect economic projections to really land on those dots they indicated?
Yeah, I think that's another symptom that central bankers are caught between, a rock and a hard place. There is a feeling that they need to wait. They need to give time the ability to unveil whether they did enough or not. But there's also, the risk that inflation remains well anchored. So they tried to navigate these two messages in one meeting. It was an awkward meeting, I would say. I'm not sure the message was well delivered, but two more hikes are penciled in the famous dot plots. While Mr. Powell was saying that they need to give it some time and take a pause, also saying that the rate cuts that some market participants are expecting, maybe they're a couple of years out, which is a very peculiar statement. I mean, committing for 2 years is peculiar. So maybe how we look at it is that we think there are maybe some hiking left, maybe 1 or 2 hikes, maybe as soon as July. Then after that, a pause, and maybe we'll see a cut when it's clear that it's working, and maybe we'll see that when the unemployment rate reaches 4.5%, which seems to be a very pivotal point in their forecast. So we're at 3.7 now. Until we reach 4.5, either it's going to take a lot of time or it's going to take a significant slowdown until then. So let's see how the economic data unfolds.
Interesting. So we spoke a lot about recession, the monetary policies, the strength of the labor market. How do you take that in within the balanced portfolios, and how that has that impacted what you've traded lately, or how you've positioned the portfolios?
Sure, of course. So we have a very macro top-down framework. We believe in that framework. It's been very useful in the past, and the signals we get from this framework are still very consistent that there's some weakness ahead. But of course, H1 2023 was more about AI, tech, momentum, sentiments. Of course, macro investing wasn't the style that was in favor in the first part of this year. So we're not really changing our asset mix right now. We still stick by our strategy of being rather neutral. We do have some underweight on U.S. equities. We have an underweight on high yield bonds. We think they're priced too aggressively. We have some duration from in sovereign bonds. We have some high quality names in short duration corporate sector. So we still stick there, but we are being active in rebalancing the portfolio managers that are within our funds, so rebalancing the styles. This is a great year for stock pickers. So anyone who's been more involved in tech and AI in 2023 is doing well. And also we see a good opportunity now. I mean, we've been waiting for months to be able to do that, but now we're getting near the moment where, you know, everything's in place for us to start investing more massively in a Dan Rohingston's global dividend fund. So this is a fund that we've been eyeing for a while. The manager has a great ability to pick the right stocks, is a conviction for a manager, and we think this is exactly the kind of style that we need to put more of in our portfolios in this particular environment.
Great to hear. Maybe taking the discussion on portfolio allocation a bit larger, like a lot of investors have been kind of complaining about the 60-40 allocation, some even saying that the 60-40 is dead. Has your opinion changed, or are you still like have a lot of conviction in the 60-40?
Yeah, no, 60-40 is far from being dead. In fact, it's a very good strategy in 2023. We've been vocal in 2022 to say that even though it was a disastrous year for the 60-40, it was a one-of-a-kind year. It wasn't something that we expected would be a game changer for it. And now, remember, if you bring yourself back in the 2010s, it was all about U.S. equities. Rates were very low, so you didn't get much return on bonds. The money market wasn't giving you anything. So it was, you know, the only game in town was equities, and more especially U.S. equities. Now you have the cash rate that's very high because of monetary policy. You get 5% on average on money market. You get between 3.5 and 4% for 10-year bonds in North America. Plus, you have the potential for capital gains if we do have an economic slowdown ahead. You see that the U.S. stock market, yes, it's expensive. There's good momentum there. But if you go outside of the U.S., global ex-US stocks are not expensive. Canadian stocks in particular, we like a lot. So a balanced portfolio, 60-40, is not dead yet. It's not dead at all. And in fact, so it might be one of the best few years for this style that we'll see ahead of us.
Good. I'd like to conclude, like we're almost at the end of June. What's your outlook? Are you positive for the rest of the year? What's keeping you awake at night, if anything?
Well, I sleep very well, thank you. But it's yes, we are positive for the second half of this year. Even though we're expecting an economic slowdown or even a shallow recession, we see that there's a good margin of safety in Canada, in Europe, in a global ex-US stock, so the market is not that expensive. The US stock market is expensive in spots, so trading carefully there will be important. But rates are higher, so if we have an economic slowdown, bonds will be doing well. Money market is still a very good option also for us as asset allocators, so we can go to cash and reap a 5% return. So yes, we tend to be to look at H2 2023 with some good feelings.
Good, happy to hear. Well, thank you, Sébastien. It's always a pleasure to have you, and I wish you a wonderful summer.
Hey, thank you. You too, Rose.